Welcome everyone to the State of the U.S. Housing Market webinar hosted by Rick Sharga. We have a few more people trickling in, so we're going to give it just a few moments. Thanks again for joining us. Welcome everyone to the State of the U.S. Housing Market webinar hosted by Rick Sharga. We still have a few more people trickling in, but we're going to go ahead and start. Well, we want to again welcome you to our webinar, and we will be having Rick Sharga host. He's Executive Vice President of Carrington. Rick Sharga is an industry veteran who recently returned to Carrington Mortgage Holdings as an Executive Vice President after 5 years with Auction.com and 10X. One of the country's most frequently quoted sources on real estate, mortgage, and foreclosure trends, Rick has appeared on CNBC and the CBS Evening News, NBC Nightly News, CNN, ABC, Fox, Bloomberg, and NPR, and briefed government organizations such as the Federal Reserve and the Senate Banking Committee. Rick is a member of the Corporate Board of Governors of the National Association of Hispanic Real Estate Professionals and Advisory Council of the Asian Real Estate Association of America and the Five Star Institute National Mortgage Servicing Association, and was included in the Inman News' 100, an annual list of the most influential. It was called an annual list of the most influential leaders in real estate in 2003 and 2014. So he will be your host for today. Hopefully everyone can see our screen. We do have just a few opening notes before we get started. If you're having any technical problems, audio issues, please hang up and call back in. Make sure you are not using your computer for audio. If you're having video issues, log off or restart your computer. Also, we may have time for questions at the end. If we do, please enter all your questions in the question panel. We'll answer all the questions at the end of the presentation. Now we will be handing the presentation over to Rick Sharga. So give us just a moment. Rick, I am handing it over to you. Rick, you should have it now. It's all yours.
I have it, but I don't have the presentation.
Okay, give us just a moment. Do you have the presentation open? Nope. If not, we could go ahead and run it for you, Rick. Would you like that?
I can. Yeah, so basically, should I use a copy that I have on my computer instead of the one you were using?
Well, I have it up on the screen right now. If you'd like, we can go ahead and just control it for you. Just let us know when you want the pages turned or the slides, when you want us to move to the next slide.
I'll do it from here. It's okay.
Okay.
So bear with us, folks.
Yes, we apologize. Technical difficulties here. We do see it, Rick, so if you could just have it open.
Got it now?
Yes, we see it. If you could just make sure you hit slideshow on it.
Yeah, I did. So you should be seeing the what we'll cover today slide. Is that what you're seeing, Elizabeth and Michelle?
Yes, we are seeing that.
So let's just plunge right in, and we'll take it from there. Thank you, as we said earlier. Thank you for joining us. Good morning or good afternoon to those of you on the East Coast. We're going to try and cover an awful lot today in a relatively short period of time, and I'm going to try and leave some time for Q&A at the end. We're going to look at the U.S. economy. We're going to start with the economy because the economy really is what drives the housing market. And so it's really helpful to see where we are economically in order to figure out where we're going to be from a housing and mortgage industry perspective. We'll take a look at existing and new home sales. We'll take a look at the outlook for the housing market for the rest of this year. We'll take a look at foreclosure activity and some good news. We'll take a look at the mortgage market, what's going on there, and have some closing thoughts. And then, as I said, hopefully we'll have some time for Q&A at the end. So as we go through this, if you do have questions, if you have thoughts, if you have comments, just type them into that question area, and we'll try and address as many as we can at the end of this. And if we run out of time, we'll try and answer them after the fact. And this will be recorded and posted online. You'll be getting a link after the session. So if you miss something or don't want to take really copious notes, don't worry about that. You'll be able to access this information later. A couple words about Carrington for those of you who don't work for the company. Company was founded in 2003 and was in the business of investing in mortgage-backed securities. Grew into an asset management company, a mortgage servicing company. We're now a national lender as well. We do originations in both the retail and wholesale channels. We have a real estate brokerage. We have other real estate related services, a title company. So basically pretty much anything you need to direct a wide range of activities across the entire life cycle of single family residential sales. And we have about 4,200 employees nationwide and about 1,100 agents in our real estate brokerage. So our company's come a long way since the beginning, about 17 different operating units, which we're not going to go through in great detail here, but wanted to give you just a little bit of an overview about Carrington and the various businesses and services that we provide. Today's webinar is coming to you through Carrington Mortgage Services. And again, it's a mortgage originator. You can check out the products at Carrington Home Loans and also a mortgage servicing operation with about $56 billion under management. So I appreciate them sponsoring today's webinar, and thank you again for joining us. Let's dive into the U.S. economy, and it's not a bad place to be diving into right now. The economy is kind of running on, if not all cylinders, pretty close to all cylinders. Historically, the thing you look at first is your gross domestic product. It's sort of the government's version of a report card, of a snapshot in terms of what's going on in the economy. And by and large, it's been performing very well for the last year or so. Historically, we average about 3% growth per quarter. We haven't really been at that level on a consistent basis for a number of years, certainly not since the Great Recession. And then in some cases, you have a kind of aberration where you had a loss the prior quarter and the next quarter looks good sort of artificially. But I think the most recent number we saw was about a 2.9% quarterly improvement in the GDP. And that's forecast to be fairly steady for the foreseeable future, although there was an economics report yesterday that expects to see GDP slow down in a couple of years. But for the time being, looking pretty solid. Not quite where the projections were during the Trump campaign of 4%, 5%, and 6% GDP growth, which would be nothing short of a miracle, but still pretty solid. Inflation, if you've been following real estate and mortgages for the last few years, you probably can't avoid hearing about inflation. The Federal Reserve was targeting 2% annual inflation rate. as a sort of criteria for them to raise Fed funds rates. We've been at or slightly over 2% for a little while now. It's probably no surprise that the Fed is signaling that it will probably raise interest rates at least 2 more times this year and possibly 3 more times this year. And again, we're coming out of a period of the lowest Fed funds rates in history, literally a 0% rate for a number of quarters. So not a surprise. Inflation is something people are now starting to watch a little bit more closely, simply because of some of the economic stimulus that the current administration has put into place with things like tax reforms and regulatory reforms. And one of the questions I'm asked somewhat regularly is it's been so long since we have inflation problems, if 2% inflation is something to target, if we're looking to increase inflation. And the answer to that is really no. What the Fed has been watching for is inflation to get to a certain level and maintain it. That typically is a byproduct of something else going on, usually the economy growing. And so that was always intended by the Fed to be a signal for them that they could stop stimulating the economy and start putting the brakes on a little bit so that it doesn't get out of control. We don't have runaway inflation, but inflation under control. Unemployment we're probably as close to full employment as we've ever been. 4.1% unemployment rate. I know some people are a little skeptical of the unemployment rate. I'm going to give you a couple slides following that suggest that and put some context around that rate. But 4.1% is virtually full employment. And what's kind of interesting in a sense is that there are a lot of jobs that are still looking for people. We should start to see a little bit of pressure on wages, which again is one of the contributors to inflation. So a lot of this stuff all ties together. One of the reasons people weren't all that excited about the unemployment rate for the last few years is because the labor force participation rate had dropped, and it had dropped particularly in the prime working ages of 25 to 54. And what that meant was the unemployment numbers were artificially low because a lot of people were just voting themselves off the island and had stopped looking for work. That's not how you want to actually drive unemployment rates down. You want that to be more organic and based on job creation and people meeting the requirements for those jobs. What we've seen over the last year is a slight uptick in the labor force participation rate. That means more people are entering the workforce. And interestingly enough, even though more people are entering, we haven't seen the unemployment rate go up. So that means the people that are re-entering are finding jobs when they get there. And that's a really good sign for future growth. This is the overall participation rate. It's for ages 18 and up, really kind of through about 65. If you looked at the 25 to 54 age group, that number is somewhere between 83 and 84% right now. Still a little bit lower than normal, but trending in the right direction. One of the other reasons people have been looking at the unemployment numbers with a little bit of skepticism is we have really since 2009 been at almost record levels of part-time employment, and this criteria is a little skewed by the gig economy. We have a lot of people that are driving for Uber and Lyft part-time, maybe doing some Airbnb stuff, not your typical part-time jobs. But it's also undoubtedly due to a lot of people who haven't been able to find a full-time job and have patched together 2, 3, sometimes 4 part-time jobs in order to make ends meet. So this is another thing to watch as the economy continues to move forward, is if we do start to see a reduction in part-time employment. And although it's hard to tell from this chart, the numbers are actually trending a little bit in the right direction, but doing so pretty slowly. This is really positive news. There was a jobs report just this week that we didn't have time to plug into this chart, which was the lowest number of jobs created in several quarters. It was in the 110,000 range. But what we're still looking at is on average over the last 4 quarters, about 200,000 jobs created. And that's really what's driving, we believe, the unemployment numbers down. A lot of job creation. And sustainable job creation. The really good news about this is that based on what we're seeing in terms of wage growth, These are not service level jobs. They're not temporary jobs. They're not government jobs. These are actually all jobs paying a living wage. And that's putting pressure on wages to go up. That's ultimately going to reduce the number of part-time jobs. That people aren't doing that by choice but by necessity. So if you look at all of the economic criteria that would typically determine how a housing market is doing, GDP is strong, inflation's under control, unemployment is historically low, we're creating new jobs, wages are going up, and all of this is heading in the right direction. So we really should be seeing a housing boom. And so why don't we just check in on housing and see how it's doing 10 years after the crash. And unfortunately, the truth of the matter is that existing home sales are off to a pretty weak start this year. We don't have March numbers in. I think NAR will probably report those somewhere around the 20th of this month. But if you look at these numbers from Calculated Risk, you're seeing that in January we were actually down on a year-over-year basis. In February we were up marginally, but almost flatlined from a year ago, and we're well off the record numbers that we set back during the housing boom. So existing home sales, despite the fact that a lot of economic tailwind should be pushing the market forward, really have kind of stagnated. We wound up last year with somewhere in the neighborhood of about 5.4 million existing home sales. Based on what we're looking at right now, it looks like we're going to come in at just about the same number in 2018. To put that in perspective, by the way, given the economics I talked about earlier, given our demographics, our population, the number of households being formed, we should probably be closer to about 6 million annual sales in terms of existing homes. So we're off by a good 10% from where we should be. And the biggest culprit in this is the lack of inventory. There's simply not enough inventory to meet existing demand. If you look at the chart here, the line running across the lower third of the chart shows that normally you'd be looking at about 6 months supply of inventory. Right now, inventory is a little under 4 months supply, which is as low as we've seen it pretty much ever. And on a year-over-year basis, it's trending up, but not enough up to really make a noticeable difference. A lot of reasons for lack of inventory. We'll talk about new homes in a few minutes. There's also still, according to First American, about 2.5 million homeowners who are underwater on their loans and can't sell their properties. My best estimate is that there's another 2 to 3 times that number who are either at neutral equity or don't have enough equity in their homes to be able to afford to sell them off and move into a bigger home. We also have a little bit of a psychological hangover that's starting to happen now, at least according to some research that's been published, where people are afraid to put their home on the market because they're not sure there's something for them to buy if they sell their house. So, keeping in mind that existing home inventory is usually between 80 and 90% of what's out for sale, with new homes making up the balance of that. The fact that a significant percentage of existing home inventory is not for sale right now is really one of the driving factors. People are also staying in their homes longer. Typically, in years past, if somebody took out a 30-year fixed rate loan, they were out of that house in 5 to 7 years. Right now, the average is about 10 to 11 years. So we're seeing people stay in their homes longer. Again, some of the major reasons we're not seeing the inventory we would normally be seeing for sale. Scarcity is driving prices higher. I have a few charts on this. It really doesn't matter whose numbers you're looking at, but according to Black Knight's Home Price Index, we're looking at a new median home price that's higher than the prior peak, which was set back in 2006. So according to Black Knight, we're looking at about 6.6% home price appreciation in 2017 compared to 2016, and the new median home price is about $283,000. Case Shiller shows very similar data, and if you look at either their national index or their 20 market index, which are the two lines you're looking at on the chart here, both of those, the 20 market index is a little bit above its prior peak. The national index is well above its prior peak. So this is economics 101. If there's not enough supply to meet demand, people wind up bidding on assets and prices go up. This, by the way, is not universally true in terms of pricing. This has not happened in every market across the country. If you look at Florida, for example, prices are still on a median basis about 20% below where they were at peak. Nevada has not reached its prior peak. There are parts of California, even though the state is past its prior peak, the Central Valley of California is not where it was back in 2006. So we've had basically a kind of tale of two countries, with parts of the country rapidly escalating in prices and seeing those prices far surpass prior peaks, and other parts of the country still kind of trying to catch up. But what I want everybody to keep in mind is that if you take this in context, looking at the same numbers we just looked at from Case-Shiller, affordability is actually better than people think. What you have to keep in mind is that that prior peak was reached in 2006 dollars. Since then, we've had 12 years of inflation. We've had 12 years of wage appreciation. And we're actually, even with the recent increases in interest rates, we still have lower mortgage rates than we had back in 2006, when the average mortgage was usually somewhere in the 6 to 7% range. So if you factor in all of those things, even with the median price being higher today than it was back then, affordability, nominally anyway, is better across the country than it was back then. First American puts out something they call a real price index that looks at those factors that I just mentioned. And the green line running across the bottom shows you what the difference is in affordability today, again, in 2018 dollars compared to what it was if you didn't adjust for those variables. And Black Knight does the same thing. If you look at the payment to income ratio, you can see that the numbers today are better than they were back in 2006. They were 34% then. They're about 23% now. Now, local results will vary wildly. There's also, as I mentioned, always consumer psychology involved, and looking at a price tag of $283,000 for a house as the median price will certainly give a lot of people sticker shock. So there's perceived affordability and there's actual affordability, but in many cases those numbers kind of get blurry. Bottom line is as you're out there in the market, keep in mind that even though the prices look really scary, relatively speaking, they're not as bad as they were back in '06. New home sales also haven't been particularly exciting. We're seeing a little bit better news in terms of inventory. The month supply is creeping back up closer to 6, but we sold around 620,000 new homes last year. The most optimistic projections I saw this year were somewhere between 650 and 700,000. Based on current trend lines, it doesn't look like we're going to get there. It looks like we're going to probably finish somewhere between 625 and 650,000. And again, inventory is the biggest culprit. I actually saw talking head on one of the cable stations suggesting we'd see 1 million new homes sold this year, and I thought that was fascinating since we're not making that many new homes. But maybe he knows of some secret supply in the desert that we're not aware of. So new home sales are lagging behind previous recessions. This is something I'm kind of a data geek, so I found this fascinating. I hope you find it a little fascinating too. If you look at all those blue vertical lines running across the chart here, those all represent prior recessions. And in virtually every recession, as far back as you can go, even really going back as far as World War II, what you saw as the recession ended was home construction and home sales, new home sales start to percolate. And that actually helped the country get out of the recession. Just the opposite happened this last time. In fact, when this recession started, you saw new home sales continue to go down and really hit a new low. And the reason for that is that in this case, it was housing that took us into the recession. It was housing, it was questionable lending practices, which led to a financial market meltdown. And at that point, the builders were caught with an oversupply of new homes. There were cases that I remember talking about back in the day where banks who had to repossess foreclosed developments, rather than finishing the developments, bulldozed the ones that hadn't been completed because there was too much inventory. And for a while there, we had this phenomenon of foreclosed homes that were a year or two old that the builders had put into the market and were now trying to compete with with smaller, higher priced homes, and it was a real mess for the builders. So we are seeing a return to sales that are more like normal. But much as I mentioned earlier, given our economics, given our demographics, given our household formation, we really should be looking at something closer to 800,000 units a year in new home sales, and we're going to fall well short of that this year. And a big part of that, again, is supply. This chart really outlines things pretty well for the new home market. The red area is new homes that are completed and available for sale. The blue area is homes that are under construction, and the green area is housing starts and permits that have been issued, but the construction hasn't started yet. And the most positive part of this chart, the most hopeful part of this chart, is the blue area, which we see continue to grow from the doldrums that it suffered in a few years back. But if you look at the red line, you can take a look at what I was talking about. If you go to 06, 07, 08, even after the meltdown had started, there was still a large number, a record number of new homes being completed, and then that construction fell off the map. But we are starting to see the trends move a little bit in the right direction. They're not quite there yet, but again, we're starting to see a return to something a little bit more normal. And if you look at housing starts, keep in mind when you're looking at housing starts, you're seeing reports on housing starts in the media. They don't usually refer to just single-family units. And for a long time, during the recovery from the Great Recession, those housing start numbers were a little bit artificially inflated because the numbers included multifamily units, apartment buildings, and duplexes and triplexes and so forth. Those numbers are starting to scale down a little bit, and new home starts, although they're happening in a kind of jagged line, are trending up in the right direction. So again, more good news than bad news. It's just taking a lot longer than most of us had anticipated, or frankly, than most of us would like. You are seeing a growth in single-family permits in most parts of the country, and the South and the West are typically the parts of the country that drive new home sales and new home growth. There are some headwinds, though, and a lot of them are locally generated. The state of California, for example, it costs a builder $100,000 on a project before they break ground on a single house. So if you're wondering why there's very little inventory available for entry-level buyers, very little affordable inventory left or coming to market, keep in mind that for that builder, it costs $100,000 before they even start to build. Very difficult to create affordable housing if that is your bottom line. And it's not just a California problem. The number, according to Fannie Mae, is about $80,000 across the country. It's just a little bit more severe in California. We also have other issues that are plaguing the builders. Since the tariff on lumber from Canada was put into place, we've seen lumber costs go up by about 25%. That does have an impact on the cost of building homes. Labor force has been in short supply, and something in the neighborhood of 39 to 42% of construction labor has been immigrant labor. A lot of that pool has dried up over the last couple of years. And until we have a sort of comprehensive, cogent immigration policy, I think it's going to be hard for the builders to find the kind of labor that they need. Labor has also been exacerbated by the natural disasters we had last year in Texas and Florida and in California, Puerto Rico as well, where a lot of the labor that might be going toward new home construction is instead going to rebuild those areas. So labor, regulatory issues, capital constraints. Imagine being an independent builder going out to raise capital, telling your investor that it's going to take you 12 to 18 months to start a project so you can get through all the regulatory hoops, and then it's going to cost $100,000 before you start building. And so your capital is going to be tied up probably for 18 to 24 months before you're able to bring a product to market. Really, really tough market for the builders right now. On the flip side of that, we do have some good news on the foreclosure side of the business. And for those of you who work in the default industries or whose businesses specialize in distressed properties, this is kind of a canary in the coal mine moment for you. It is really time to start diversifying and looking at other things because the foreclosure rates are dropping rapidly. We're now looking at foreclosure activity at the same level a level we haven't seen since somewhere between 2005 and 2006 before all the bad stuff started to happen. These are numbers from Atom Data Solutions, formerly known as RealtyTrack. And their numbers include all three phases of foreclosure. So they're looking at the initial notices of default, they're looking at the properties that are scheduled for auction sales, and they're looking at REO actions, the repossessions by the lenders. And so when you're looking at all three of those categories, this is what activity rates look like today. And my belief is that by next year at this time, we'll actually be looking at rates that are below historical foreclosure activity rates. There's simply nothing new entering the pipeline. You're seeing foreclosure activity concentrated in a number of states. This particular chart shows scheduled foreclosure auctions, which is really the final step in the foreclosure process. But no matter what you're looking at, there's a backlog of distressed properties, of loans in foreclosure in a handful of judicial foreclosure states. These are states like New York, New Jersey, Illinois, Massachusetts, Maryland, to a certain extent Florida and Illinois, where it's taking anywhere from 900 to 1,300 days to do a foreclosure. So from the time of that initial notice of default, that borrower is probably living rent-free in the house for the next 3 to 4 years. And those are the loans that are finally making their way through the foreclosure pipeline. There's an overhang. When those are through the pipeline, there is virtually nothing coming in. And I apologize, it's a little bit of an eye chart, but it's one of the best charts you can find. It's from a report called the Mortgage Market Monitor that's put out by Black Knight. They do one of these every month. And I would call your attention to the first two lines in this chart. The first one is the total delinquency rate. In a normal market, historically, about 4% of loans have been delinquent. And that's anywhere from 30 days to however long it takes before a loan is put into foreclosure. During the peak of the foreclosure crisis, that percentage rate had gone between 11 and 12%. So it was almost 3 times what the normal level was. The next line, the total U.S. Foreclosure inventory rate. So these are all the loans that are in foreclosure. In a normal market, again, you're looking at about 1%. In today's market, you're looking at 0.65%. So it's running about a third lower than normal. The 4.3% delinquency rate is actually a little higher than it would be because of the hurricanes in Florida and Texas and the wildfires in California. But those numbers have been coming down on a month-over-month basis since the catastrophes, and we can expect those numbers to come down. So keep in mind, even with the backlog we're talking about in states like New York and New Jersey and Illinois, we're looking at foreclosure rates being a third lower than usual. My speculation is that by next year, that number is going to be even lower. So again, anybody who specializes in the default services industry and working with distressed properties, simply not going to be a lot of those properties to go around by this time next year. And the foreclosure start rate, the third line there, 46,700, you can see down 25% from the previous month, down 19% from a year ago. Again, there's some seasonality to these numbers, but there's just nothing going into foreclosure right now. So the good news, nationally speaking, is that the foreclosure crisis really is finally over. And if you look at Fannie Mae and Freddie Mac numbers, they're showing exactly the same thing, getting back to levels they haven't seen since right around 2006, 2007. And that's serious delinquency or in foreclosure. And again, a lot of the Fannie and Freddie, a lot of the larger institutions have sold off a lot of their non-performing loans to companies like Carrington, who have got those loans reperforming. In most cases, somewhere between 2/3 and 3/4 of the cases, they were able to work with those borrowers and avoid a foreclosure. But that pool of non-performing loans is rapidly drying up, and the foreclosure inventory, a lot of people have been waiting for the shadow inventory to hit. There is no shadow inventory. It's not going to hit. Waiting for the next wave of foreclosures. I simply don't see one from any distance, any particular catalytic event. What could put us into another wave of foreclosures is an economic recession. And most of the economists I talk to agree that we're not likely to see a recession until sometime in late 2019, early 2020, which means you wouldn't see people really in foreclosure until late 2020, early 2021. And as I mentioned earlier, some of the aged foreclosures are really skewing the picture. What we are seeing also is the loans that are coming to foreclosure sales are starting to be sold in larger numbers to third-party buyers. These are typically investors who go to the foreclosure auctions at the courthouse steps or at the sheriff's sale, and they will buy those properties. But during the peak of the crisis, most of the properties were reverting to REO and going back to the lenders, and we're simply not seeing that the same way we did in years past recently. So with all this, what's going on in the mortgage market? And we're coming out of a period where the pendulum swung too far the other way. We went from people who could barely fog a mirror getting a loan to people with almost perfect credit not being able to get a loan, and now rates are going up. So what's likely to happen? One of the myths I would like to dispel today is that there's a direct correlation between the Fed funds rate and mortgage rates. In fact, if you look at the last decade of Fed fund rate activity and mortgage rate activity, you can see that there's virtually no correlation. The Fed, for all intents and purposes, went to zero or close to zero back in 2009 and didn't budge until about a year and a half ago. And look what mortgage rates did during that period of time. They went from about 5.5% down to about 3.5%, back up to about 4.5%. Again, virtually no correlation. And the truth of the matter is that the Fed funds rates typically have more of an influence on short-term interest rates, and mortgage rates are very much more typically tied into a longer-term criteria like this one. And if you want to look at a correlation for what's going to happen with interest rates in the mortgage industry, take a look at the yields of U.S. government 10-year Treasury bonds. And there is an almost lockstep relationship between 10-year bonds and the 30-year fixed rate mortgage. Right now, the industry, the mortgage industry, I believe, is outpacing the bonds a little bit. You can see that, and this probably is a quarter behind in terms of mortgage rates, but you see that rates are outpacing the bond yields a little bit as there's pressure on U.S. Treasuries from a variety of different areas. We're talking about the recession, the potential of a coming recession a few minutes ago, and a little data point that I found interesting. I was recently at the REOMAC conference out in Palm Desert. Had a chance to talk to Dr. James Doty, who's the former president of Chapman University. And if you ever want to see one of the best econometric models in the country, and you have a chance, go check out one of the Chapman presentations. They're about as accurate as it gets. Dr. Doty said they've been trying for decades to figure out how to accurately predict a recession, and are still working on the math. But one of the things they did find was an interesting inflection point. And so we just talked about the Fed funds rate, and we talked now about Treasury bond yields. And he said something they found that's happened pretty much without fail since World War II is when Fed funds rates rise or to a point where they become higher than the bond yields. So if bond yields go down and Fed funds rates go up and they cross each other, when you have that inflection point, almost invariably you're going to see a recession within about 6 months. So the Fed, as I mentioned earlier, has announced plans to probably raise rates at least 2 more times this year, possibly 3. So those rates are going to go up, and watch what bond yields do at a similar time. And if you do see those things cross over, it's probably a fairly safe bet that you might see a recession sometime within about 6 months. That said, we've taken a look at what 30-year fixed rates are doing. I wish I could have done about a 20-year snapshot of this, because everywhere I go right now, people are kind of mortified by the notion of interest rates being 4.5% and 5%. And I'll be the old guy on the call right now and talk about all you young whippersnappers not knowing any better. But my first mortgage had 2 numbers to the left of the decimal. I believe it was about 11%. And I was on a panel with somebody in DC last week who mentioned that He happened to be fortunate enough to have a mortgage at the all-time peak of mortgage rates, which was, I think he said 18.75%. And people still manage to buy houses, and people still manage to afford houses. And so while it's very real that we're looking at a generation of home buyers who has experienced nothing but the lowest mortgage rates in the country's history, and will have a little bit of sticker shock, these are manageable numbers. One of the other myths I should probably dispel today is the myth that as interest rates go up, home prices come down. There's simply nothing in the data that shows that correlation over time. But what you do have is an adjustment period, and what you probably have, although it's hard to pull the numbers out, is a little bit of a correction. So home prices might not come down, but home price appreciation slows down significantly. And that's one of the things I probably should point out about what we're seeing in the market today. People ask all the time about whether we're looking at a bubble because home prices are going up as high as they are in some markets. And it's easy to understand if you're in a Seattle where prices went up 12% last year and haven't slowed down much this year. If you're in the Bay Area of California, if you're in Austin or Dallas-Fort Worth, where home prices have gone up at ridiculous rates over the last few years, it's easy to see why people are worried about a bubble. What we've seen instead, though, is we've seen home prices get to a certain point. We've seen buyers back off. So sales drop down. When sales drop down, amazingly enough, home prices fall and buyers come back into the market. This is how a normal market behaves, and it's how it's supposed to behave. And it's probably been so long since we've been in a normal housing market that we've all forgotten what that actually feels like. But that's really more what we're seeing in the market today is less of a bubble than a handful of markets that are probably overvalued and churning a bit, based largely on supply and demand and on an influx of very highly paid employees who are moving into work for largely technology companies. And that does drive the prices up. It doesn't necessarily mean those people can't afford the prices they're paying, although it does call into question whether the absolute value of those prices is really what it's cracked up to be. But nationally, you're not seeing the same sort of thing. Again, if you look at home prices adjusted for inflation and wage growth, we're not seeing a bubble. Not saying we couldn't see some individual markets lose some value or even home price appreciation dip a bit. One thing I hope we all learned from the last cycle was that home prices don't always go up; they do sometimes come down. But there are huge chunks of the country where even with the interest rates going the way they're going, even with home prices being what they are today, the affordability is pretty good. So we are seeing the rates go up. If you look at rates over the last 25 years, they've averaged out at about 8.25%. If you look at where they were during the last housing boom, where everybody was buying a house, whether they needed to or not, again, you were somewhere between 6 and 7%. So again, we're still within those, well within those parameters. And most people I talk to believe that by the end of this year, the 30-year fixed rate mortgage will probably be somewhere in the neighborhood of 4.75 to 5%. And that's what we should probably anticipate on a go-forward basis. I think the days of the wonderful 3.5% 30-year fixed rate loans are probably behind us, at least for the foreseeable future. I mentioned we're still at the low end of the historic rate. You go back earlier than 1995, and you see that 1990, you're seeing that we were back in double-digit rates. What I should have done is really shown you a home pricing chart compared to this. I will do that for the next webinar. But again, what you would see is over that period of time, home prices have generally gone up. We had the huge fall off between 2008 and 2011, but a remarkable recovery since then. So the home prices will adjust. I suspect this is one of the other things that will probably keep the housing market from recovering in a very rapid way this year. It'll keep the numbers down a little bit, as there will be some adjustments as borrowers who are on the margin, who were thinking about buying, whether or not they could afford to buy, may have to wait a little longer, save a little bit more money before they come back into the market. And frankly, credit availability is still very, very tight. The Urban Institute put out a report that suggested that between 2009 and 2016, About 6.3 million borrowers who normally would have qualified for a loan weren't able to get one in today's risk-averse environment. That's why companies like Carrington, warning, here's a commercial plug, but companies like ours, Carrington, are actually introducing a new series of loans that are aimed at those borrowers who normally would have been able to get a loan, who are very credit worthy, but had a blemish on their credit somehow, or had a high debt load, or had some other imperfection in their credit rating that's made them toxic for many lenders today. We believe those people really do deserve a choice or a chance at home ownership, or the chance to tap into the equity of their homes to make their life conditions better by maybe paying down credit card debt or paying for college for one of their children. And so if you haven't already, you'll be seeing some information out from Carrington Mortgage Services about FHA loan products, about VA loan products, and about our own proprietary products that are really aimed for people who have credit challenges and haven't been able to get a loan in today's markets. Our servicing organization specializes in working with borrowers to help them stay the course and stay in their homes. And so we're very excited about that opportunity and working with industry professionals to make those opportunities available to consumers. Even with rates going up, if you this kind of looks like an EKG, doesn't it? The black dotted line. But if you look at mortgage applications relative to interest rates going up, although the line goes up and down, and it does so rather dramatically, people don't like sticker shock. So you'll see when rates go up, applications do fall off, but they bounce back up. And there's really, outside of a couple points in time, back in 2015, for example, when the industry decided to raise rates by a full point overnight, we saw a dramatic drop off in applications. Back in late 2014, when rates dropped precipitously, we saw a pretty big uptick. But when you're talking about a few basis points, you're really not looking at those kind of dramatic upticks and drop-offs. And the market's performing about the way we had all anticipated it would this year. We're seeing purchase activity tick up. And whether you're looking at the 4-week moving average, which is the red line, or the purchase index, which is the purple line, these are numbers from the Mortgage Bankers Association. And refi activity is dropping off pretty precipitously, and that's to be expected. A lot of the refinance activity that we've seen over the last decade or so has been rate-based refi activity. So people were taking advantage of that historically low rate environment and coming in trying to lower their monthly rates or refinance into a shorter duration loan. There are, relatively speaking, very few people left who still qualify, have high enough interest rates that today's rates would represent a significant savings for them. So we're seeing far fewer refinances, and the refinances we are seeing tend to be more of the cash out variety. So we'll see an increase in volume of cash out refis, in the number of cash out refis. But if you're in the lending market, keep in mind that typically a refi loan is going to be a far lower dollar value than a rate-based refi. And so the actual dollar figures are going down. And not surprisingly, we're seeing a lot of consolidation in the industry. We've seen 2 non-bank lenders sold in recent weeks to competitors. We're seeing a lot of the lenders who specialize in refis adjust their staffing to accommodate lower volume and lower dollar value. So it's an interesting time, as the Chinese curse goes, to be in the mortgage industry these days. But as always, the industry will adjust. So in closing, and then it looks like we probably will have a few minutes open for questions. I tried to go through this as quickly as possible. Hopefully I haven't blown by this stuff too fast. If you like last year, you're probably going to like this year. It's going to look pretty much like a repeat performance. There are strong headwinds challenging the housing industry. Biggest one being limited inventory, but you're also seeing home price appreciation and rising rates. And for borrowers who are marginal borrowers from a financial ability standpoint, that will pose some affordability issues. And again, handful of markets that are probably overpriced: coastal California, Pacific Northwest, parts of Texas. And prices will probably continue to rise. It looks like between 5 and 6%. We saw, I believe, one index last month in February showed about a 7% year-over-year pricing. That, by the way, is unsustainable. If wages are going up 3% a year and home prices are going up 6 or 7% a year, at some point that math simply doesn't work anymore. We're not there yet, but if the prices continue to go the way they're going, it's inevitable. And existing home sales and new home sales, for all intents and purposes, look like they're probably going to be flat this year. Even the National Association of Realtors, whose motto, I believe, is "We have to be optimistic about home sales," recently adjusted their numbers, and they're looking at pretty much flat year-over-year numbers as well. New home construction is starting to come back, not enough to meet demand. And in fact, if you look at obsolescence, at the number of properties that basically are pushed out of use over the course of a year, new home construction is not quite meeting replacement value. So the type of property, you're seeing fewer properties being built than what we'd like to see, and those properties tend to be at the higher end of the market. And that's because if you're a builder and you're selling limited inventory, you want it to be as profitable as possible. And it makes a lot of sense for the builders to do that. Interestingly, we're also seeing a couple other trends. We're seeing builders who are building to rent, and they're building single-family units to rent. So these aren't multifamily units. These are actually single-family rental units, and they're trying to meet the needs of that cohort that's opted to live in a house but doesn't want the financial commitment required to take out a mortgage. A lot of these folks are Generation Xers who had their finances trashed during the Great Recession. At one point, they were the largest. They had the highest percentage of home ownership of any age cohort, and they got hammered the worst during the foreclosure crisis to where they have the lowest percentage today. So a lot of those have opted to rent, and again, that's one of the trends we're seeing in the construction business today. Talk about the reasons for the builders to be a little bit behind. There's prices, there's regulations, there's labor shortages. And in terms of inventory, those borrowers who are underwater and almost underwater continue to be a hidden problem. Foreclosures really aren't a factor anymore. I am speculating that, again, by next year, because of the risk aversion that lenders have had over the last decade, because of some of the regulations in place, we're probably going to see historically low numbers of foreclosures and delinquencies in the next year. And it'll be interesting to see what impact that actually has on the market. And then there will continue to be big changes in the mortgage market as prices adjust. We're likely to see a 5% 30-year fixed rate loan by the end of this year. And we'll look at more purchase loans, fewer refinance loans. And then refi activity is going to shift from rate base to cash out. And so that's pretty much the end of my prepared comments for today. Looks like we have 6 or 7 minutes left for questions. Anybody who's interested in this kind of stuff, feel free to follow me on Twitter. That's my Twitter handle there, @Rick Sharga. You can also follow Carrington Mortgage Services on Twitter. And we recently started putting up a Carrington corporate Twitter account. It's Carrington Holding Company. So there's pretty much no escaping from us. And if you'd like to reach out on LinkedIn, feel free to do that as well. Not hard to find me there. Just mention that you attended the webinar and would like to connect on LinkedIn. I'd be happy to do that. So with that, I will exit my presentation and turn control back over to my colleagues. And if there are any questions, we'll try and address them now.
Great. Well, thank you, Rick. So we do have a couple questions that have come in. I'll read them to you. One of them is, what about the labor participation rate as it relates to unemployment?
Yeah, I think we did address that, but just to circle back in case somebody joined late. One of the reasons people were skeptical about the unemployment rate and suggesting it wasn't as low as the numbers indicated was that we'd seen labor force participation rates drop over the last 5 to 10 years. And that was particularly true in the 25 to 54-year-old age group, which is defined as the prime working ages. And if the only reason unemployment rates are going down is because people are no longer looking for work, that's kind of a false positive. What we've seen over the last couple of quarters is labor force participation rates start to tick back up. We're still not far off our 30-year low, which is what we hit really sometime in the last 5 years. but we are trending in the right direction. And what's been interesting and very encouraging is that as more people have re-entered the labor force, the unemployment rates have not gone up. So the people that are re-entering are finding jobs, and the labor force participation rate for the prime working age folks, the 25 to 54-year-old folks, is somewhere in the 83 to 84% range. So it's a very strong number, not quite where it should be, but trending in the right direction. Thanks for the question.
Okay. If you'd like to take one more, Rick, I'll keep reading. You let me know when you want to cut it off. Here's another question that came in. What effect will the coming massive federal deficit have on rates and the housing market?
I was having such a good time this morning until that question. That one's, candidly, that's probably the elephant in the room. And if you were to poll 12 economists on what kind of impact the federal deficit is going to have on housing and rates, you'd probably get 24 different theories, and nobody would be willing to put their names to it. I think unless we do something about the deficit, and by deficit, I'm really not referring to current spend levels. I'm referring to the fact that we're, somewhere in the neighborhood of $20 trillion in debt. Within the next decade, virtually all of the country's discretionary income will need to be going to debt servicing. And as the government borrows more money, that drives rates up for everybody else. So that's such a big issue that it's the sort of thing where when you're doing these kind of forecasts and outlooks, it's almost impossible to project against. If you had told me that under the Bush administration we would have built up more debt than in all the prior administrations before that, and then in the Obama administration we would double the debt that was left over from the Bush administration, and the housing market would continue to recover, I probably would have scratched my head and tried to figure out how that was the case. So the economy, the U.S. economy, the housing market have been incredibly resilient despite this. But clearly it's something that the powers that be have got to start addressing, or there will be serious repercussions and probably much worse than even we can speculate on today. But I don't have an answer. My belief is that at some point this starts to get taken care of. Otherwise, the economic repercussions are going to be severe, far beyond the housing market.
Okay, thanks, Rick. So we've got another question here. What can be said about the price of resi land, which I think means residential land, either entitled or unentitled, as a driver of the lack of supply for new homes?
Yeah, that's a good question. It's a good point. I talked about some of the other headwinds in terms of new home construction. And part of it, candidly, is the lack of available land to build, and the price of land that is available to build on. And there is a fairly strong, not in my backyard sort of attitude in a lot of markets. California is probably a case in point of that. Land prices continue to escalate. The cost of building a new home hasn't risen that much over the last decade. Labor's a little higher. Materials costs are a little higher, but by and large, you're not talking about ridiculous increase in the cost to build a home. The price increases are all in the land, and so local governments, state governments make it difficult for builders to get their hands on land, and when they can, the price points they're paying is very dear these days. So yeah, it's a great point. I think that's a big factor, and again, if you're not a public builder, if you can't go to the public markets to raise capital, you're an independent builder, you have to go convince an investor to give you money to buy what's probably overpriced land that you'll then have to sit on that investment for the next 18 to 24 months before you can give the investor a return. That's a tough sell. So I do think land prices and land availability or lack thereof have absolutely been constraints on new home building.
Great, thank you, Rick. Well, we are at the 11 o'clock hour, at the top of the hour, and that is all the questions that we have. So
that's perfect timing. Listen, reach out to us. Let us know if there's any topics you'd like us to cover in future webinars. We'll certainly look to do something like this again later in the year to give you an update on how far off my projections were. But we would love to know if there's other things you're interested in us taking a look at relative to real estate, to housing, to the mortgage industry. And we really appreciate the fact that you opted to spend some of your time with us today. Speaking on behalf of all of us at Carrington, really thank you very much.
Well, thank you, everyone. That concludes our webinar. Thanks for joining us. Have a great day.